Ever heard the phrase customer due diligence? Well, it's not just a catchy line, it's a super important process. Today, we'll break it down with fun examples and real-world case studies, so by the end of the video, you'll know why banks, transfer agents, and investment fund managers take it so seriously. In this video, I will explain you what is customer due diligence, what are the components of it, and lastly how to perform it. As a bonus, in the end, I will give you a case study as an example for why customer due diligence is so important. So what is customer due diligence? Customer due diligence is like doing a background check before you let someone into your house party. You want to make sure they're not bringing trouble with them. In the business world, especially in finance, customer due diligence is like checking who your guest really is before they walk in. You find out who they are, where their money comes from, and whether they might bring any unwanted drama, like fraud, money laundering, or worse. To come back to serious stuff, in finance, customer due diligence, CDD covers the overall due diligence on the customer. It is important not to confuse it with KYC, which we explained in a separate video if you are interested. CDD starts with KYC, then continues with risk assessment of the customer, then the application of risk-based due diligence. Once the assessment is done, then defining the frequency and type of ongoing due diligence. Let me explain all these four components of CDD in more details. KYC refers to the identification and verification of customer. It simply refers to two processes. Step 1 is identifying your customer's identity by checking who your customer is. This is done by collecting basic details like name, date of birth, address, and official documents, passport, driver's license, national ID. Step 2 is verifying the information. Banks and companies cross-check the collected information with the official documents to make sure that the information about the customer's identity is authentic. Today, with digital transformation, companies even use facial recognition or selfie verification to match you with your ID. Once you do the KYC checks, the next step of CDD is to do the risk assessment. As a compliance expert, how do you do the risk assessment? Based on a selection of risk criteria you match with your customer's profile, you will need to assign either low, medium, or high risk. Such criteria cover country risk, business activity of your customer, the products and services of your company that the customer wants to use, and the screening results on the customer. Based on the name screening you perform before starting the business relationship with the customer, your customer might have a negative media hit or politically exposed person, PEP, hit that will increase the risk level you assign. This criteria of risk is of course the common and the minimum. There can be more criteria depending on your company and its business, and of course the type of customer you have. To give you an example, a local teacher would be usually low risk, whereas a shell company from a tax haven would be high risk. To chew it even a bit further, if you have a potential customer from a low-risk country, with a business activity being the person's salary, and customer willing to open an own account to invest his or her money in a plain vanilla funds, the risk would be low. But if there is a negative media or PEP hit, the risk can be increased to medium or high depending on the severity of the hit. Here you really need to understand the customer's nature of business and purpose of being your client. Why is this customer opening an account? Is he or she using own personal savings? For what he or she wants to use that money? Is it for investing in funds or anything else? All these questions and criteria would help you assess the risk related to customer. It can also help spot suspicious mismatches, like the person claiming to open a student account, but depositing millions, which is not reasonable unless there are other credible reasons. So, once you define the risk, it serves you as a guide to select what kind of due diligence measures you need to apply based on the risk assigned to the customer. Let's see now why CDD must follow a risk-based approach and what it means. Risk-based approach means applying a differing level of due diligence based on the risk you assign to customers. For low-risk customer, it would be a simplified due diligence which includes very light checks on the customer. For medium risk, it would be a standard due diligence which is a little more than the simplified due diligence in terms of checks and assessment. It would be standard checks like verifying ID, address, and source of funds. For high risk, it would be enhanced due diligence. This would be a deep dive check and assessment for high-risk customers, like politically exposed persons or businesses in high-risk industries or countries. Why do regulators require a risk-based approach? The key reason is to focus more effort and time for cases posing higher money laundering and terrorism financing risks, while spending less time and light measures on lower-risk cases. This is mainly for the benefit of companies, because imagine if there is no risk-based approach, companies would apply the same measures like enhanced measures even on customers with low risk where the risk of money laundering and terrorism financing is very low. This would also mean spending huge amount of money for doing all those checks. Once the assessment is done, another risk rating is assigned to the customer. It can be either the same risk, higher or lower risk. Reason for that is that not everything might be crystal clear before doing the initial due diligence assessment. Once the due diligence is done, the risk might be lowered if the customer is low risk, kept the same or upgraded if the customer is high risk. The purpose is to define the frequency and level of the next due diligence, which is called periodic or ongoing due diligence. Ongoing due diligence is usually required by law. In Luxembourg it is so. Due diligence must be performed on a periodic basis during the whole duration of the relationship. The frequency might be every year for high risk, every 2 years for medium risk and every 3 years for low risk cases. Though it is up to the companies to define their own frequency, the common ones are either 1, 2, 3 or 1, 3, 5 years frequency. The minimum frequency for high-risk customers does not change, it is at least 1 year usually. If you noticed by now, the main focus evolves around high-risk cases. Why? Simple answer is the main risk lies there and regulators' focus would also be mainly there. You think we are good with CDD now? Not yet, there is one more check to be done. Customers must be monitored on an ongoing basis in addition to the ongoing due diligence. What does this mean? Ongoing monitoring is part of ongoing due diligence, meaning that customers must be screened against sanctions and other lists required by regulators. For example, in Luxembourg customers must be screened not only against sanctions but also against politically exposed persons, PEP, lists. There is also transaction monitoring that must also be done on an ongoing basis. This helps ensure that the transactions done by the customer are consistent with the customer's profile, source of funds, and risk level. This also helps identify unusual or suspicious activity monitoring, which is the last component of ongoing monitoring. Whenever there is a suspicious activity or transaction detected, it may require escalation such as filing a suspicious transaction report with relevant authorities. As you can see, CDD doesn't stop once the account is open. Transactions are continuously monitored for unusual activity, like sudden large transfers or patterns that don't match the customer's profile. Now done with theory, let's get to the meat of the work and see a real-life example. Let's distill the HSBC case. There are 3 main KYC, customer due diligence findings for which the UK regulator FCA issued £63.9 million to HSBC Bank plc in 2021. The first core weakness was that HSBC failed to ensure its transaction monitoring scenarios captured the full range of money laundering and terrorist financing risks linked to its customer base. The system didn't properly differentiate between customer risk levels or apply tailored monitoring to higher risk clients. In practice, this meant some suspicious patterns were never even screened. The second weakness was that the bank did not verify if the customer profiles, account activity, country information, were complete or accurate. Missing or inconsistent KYC data meant that HSBC sometimes lacked enough verified information to determine whether its customer transactions were unusual relative to expected behavior. The third weakness was that the bank set its system rules and limits for spotting unusual activity too loosely. As a result, many warning signs were ignored. This meant the bank failed to keep a close watch on its customers over time, an essential part of customer due diligence, and didn't properly follow up when potential risks appeared. So, customer due diligence isn't just red tape, it's the shield protecting businesses and customers from financial crime. Next time your bank asks for your ID or proof of address, remember, they're not just being nosy, they're keeping the financial world safe. If you found this video helpful, hit that like button, subscribe for more videos on AML compliance, and let me know in the comments what should be our next video about.